Okay, welcome to the April 4th edition of the Fats, Fuels, and Oils webinar. Today, we're going to talk a little bit about the USDA data that came out on Friday and then on Monday. We're going to focus a little bit on canola oil and palm oil. I'll talk a little bit about soybean oil and the implications from the stocks and the acreage data. We'll cover that in a little bit more detail next week in terms of sort of the kind of acreage and yield matrix that we looked at last year. We'll kind of go through that next week. But I'm going to go into it in a little bit more detail tomorrow in a webinar that I'm doing with Ryan Standard that's put on by Stable. If you don't know who Stable is, we kind of work with them, and they can help hedge in some of the markets that don't have futures markets associated with them. David Becker's been on here a couple of times, and he kind of works with Stable Price. He kind of helps design risk management solutions, and then Stable Price is Stable, I guess, what they're really called. One of the companies that that clients can then use to sort of implement those plans. Anyway, we're doing a webinar there tomorrow, and I'll talk a little bit more about what's going on in soybean oil and what the implications of Friday's data were. Generally, what I would say is both the planted acreage and the stocks data were bullish. The stocks data was basically, it was 5 million bushels below our estimate, and what it sets up potentially is a summer where we either are really going to have to limit U.S. soybean exports or not need crush to be where it is projected to be, or some combination of the two. Because we're going to end the year with very tight on soybeans, and so there are some implications for that for soybean oil. However, I would say, sort of bottom line, I think that right now the market will probably prefer to reflect the bullishness of the reports in soybeans and meal first and second, and then soybean oil third. Not that that doesn't mean that soybean oil can still go up, but just not to the same sort of intensity that we've seen in the past because of the short oil share position that we've kind of talked about, and the implications of the drought in Argentina on the export market. But anyway, would love for you to tune in to that webinar tomorrow if you are interested. Like I said, I'm going to do it with Ryan Standard. I'm going to talk about veg oils, and he's going to kind of talk about what's going on in the fats and grease markets. All right, with that, then let's get into what the recent data also implied for canola oil, and then we'll talk a little bit about what's going on in the palm oil market as well. So USDA, in addition to the stocks data, obviously USDA also released their planning or the results of their planning intention survey for this year, and I suppose not surprisingly, given the strength of demand for canola oil in the U.S., farmers intend to increase acreage a little bit this year from last year, and you can see it's basically as high as it's been in the last 4 years, but well below sort of where it was 2018, 19, and 1920. The area where we plant canola, which of course is sort of the northern plains and North Dakota, South Dakota, and then Canadian prairies, went through a drought, not last summer, but the prior summer. And then last summer had really good weather, and the plains should be should be in relatively good condition. And in fact, there's a snowstorm that's kind of going through the area today, and then there's some more rain that's forecast over the next couple of weeks, or some more precipitation over the next couple of weeks, that should provide sufficient soil moisture for farmers to get planted. And given their planting window, it's probably not too much right now, so that it will delay planting, although concern will obviously grow if kind of the pattern repeats into later April. However, in the Canadian prairies, and apparently in parts of the Midwest, I have to take a look at the drought monitor. But if you look at the wheat spread, the hard red and soft red wheat spread, I know this is vegetable oils, but bear with me a second. If you look at that spread, it's basically blown out to a record. And part of the reason that it's blown out to a record is because there's concern about the U.S. crop, and U.S. crop ratings are really crop condition ratings are really low. And the plains obviously sort of stretch from, Texas to North Dakota, and so it's a big area, and a lot of that wheat is grown more kind of in the southern plains. But that spread blowing out partially reflects concerns about dryness in the crop conditions. And then I read something someplace else, and again, I have to look a little bit more into this, that said that the Canadian farmers were also worried about dryness in the Canadian prairies. It's hard for me to imagine, although it's not impossible, that we would have sufficient rainfall in the northern plains, and the Canadian prairies would be so dry that farmers were concerned about planting. But I need to dive a little bit deeper into that before I come back and kind of tell you what I really think about it. What I would say right now is that it's still relatively early to plant. However, if that does end up being true, then this increase in acreage may or may not materialize. And of course, all acreage will ultimately depend on weather during the planting season. If weather is favorable, I think you could see at least 2.27 million acres planted, and maybe more. The important part about the acreage and ultimately the canola production is that, as I said, the strength of domestic soybean or canola oil demand is such that we probably need every pound of canola that we can produce to crush domestically, because if you look at our imports from Canada, which we'll do here in a little bit, we're importing a lot of canola oil from Canada. And as their biofuel program ramps up, and as their biofuel production ramps up along with that program, it's obviously going to limit their the amount of canola oil that's available for export. Now, based on at least what I've done for analysis so far on the Canadian program and the impact of that program on canola oil supplies, it doesn't look like it's going to have a huge impact on Canada's ability to export canola oil, particularly to the US, which is its biggest customer since we're right across the border. So it's not, I don't think it is sort of the US market 2.0, where there are big concerns about supply and that kind of thing, but it does sort of limit at the margin the amount of canola oil that's available to come to the US, which in the most bullish case, if you combined with either a reduction in acreage or yields that fell below trend line due to dryness, would probably start to cause some concerns, because canola oil not only has domestic demand has been strong, not only on the non-biofuel side, and it's been really strong on the non-biofuel side, but we also got EIA data that showed that that Canadian canola oil, or that US non-biofuel demand was really robust in January. And we've been kind of waiting on that data point to try and figure out exactly what canola oil demand for biofuel feedstocks is going to look like going forward. So this is obviously our monthly U.S. crush forecast for this year, and you can see we expect to produce 1.79 billion pounds of crush or billion pounds of canola oil. We're effectively in line with where we were the year before the drought, and substantially above where we were for the drought year, and have really been above where we were for most of the year, or most of last year, this year as well. And despite all of that, it's not like we are just sort of swimming in canola oil. I had to raise my U.S. canola oil import forecast this week because the difference in the reported EIA data and our assumptions going forward was significant enough that that I needed to increase that, and because of that, and because non-biofuel demand has been so strong that it's really hard to imagine sort of cutting non-biofuel demand for biofuel demand. I say all of this to kind of say that while I think that, you know, we've seen canola oil prices come down to the point where they're really competitive with soybean oil. And so I think that to the extent that markets get sort of comfortable, I think that the market has gotten a little bit comfortable with the canola oil supply. And while that is definitely true for this year and for, you know, kind of the foreseeable future, which is basically until we get this next crop planted and see how things are going, that is going to remain true. And I don't really see anything that's going to change that. But what's going on this year obviously has some impact on what happens next year, but we still are relatively close to the edge, where if we do have just a little bit of a shortfall in acreage or a little bit of a drop in yield, then we're going to be back to a situation where canola oil returns to its historical premium over soybean oil. And I think that a lot of the growth in non-biofuel demand, which if you look just in the last, I don't know, it was since the last time I showed this chart, so probably the last month or so, we've raised our non-biofuel forecast by 400 million pounds. So just the growth and the strength in non-biofuel demand would tell you that that we are just a crop year away, or just even a kind of a short crop away from being really tight with canola oil again. And then that growth in non-biofuel demand that we've seen this year probably needs to revert back to soybean oil. And soybean oil non-biofuel demand has been relatively strong, although the data from yesterday's fats and oils report showed that it looks a little bit weaker. Now, it's always, we don't have the trade data yet, we don't have the biofuel data yet, so that can change a little bit from now until the end of this month, when we get the EIA data for February. But it's not, I guess, don't let the fact that canola oil is competitive with soybean oil right now kind of fool you into thinking that everything's going to be okay with canola oil going forward. I think for almost all of these markets, even though over the last 2 years, I would say expectations for usage, and I've been certainly guilty of this, have come in, actual usage has come in well below expectations. I think that, again, this year's a little bit of the opposite of the last two, where we do have enough oil, and world fundamentals look like they have been in balance. Although when we talk about palm oil, that looks like that might be changing a little bit as well. And canola oil is competitive with soybean oil, and so we can kind of get a little bit more comfortable. Prices have come down substantially from the highs. Again, this year's growing season will be just as important as the last two. And even if we do get a sort of trend line crop with both soybeans and canola based on the acreage that USDA reported, and crush kind of is where it is this year, or even grows a little bit, demand is growing so quickly that if any little part of that doesn't sort of meet expectations, then we can be back in a situation where we probably don't retest the highs. And again, it will depend on exactly what happens. If we have an Argentine style drought in the Midwest this year, we certainly will retest the highs. But it doesn't take much to kind of flip from, gee, everything's great and canola oil trades at a discount to soybean oil, to we're way short canola oil, and now we've got to figure out how we're going to get this non-biofuel demand back into soybean oil, because we've been using a lot of soybean oil for renewable fuel production. So demand is really strong, and like I said, we're importing a lot of canola oil from Canada. You can see where we are relative to last year, the prior year, and the 5-year average. And that is expected to, not only is that sort of expected to continue, although maybe not as strong as we've seen in the first 5 months of the year, but I think that we also will, if you look at the difference between sort of Canadian exports to the US and US imports from Canada, there's always a little bit of a difference there. And part of that is just the difference in timing from when Canada records the shipment to when the US records the receipt. But the other part of that difference, the other part of the difference between total US imports and imports from Canada is obviously imports from other countries. That total has been relatively small over the years, and last year it blew out to like 175 million pounds or something like that. And this year I think I'm using 200 million pounds as the difference between, or is essentially the supply from countries other than Canada. And however, if the Canadian prairies are really dry, then we're going to have to find some place to get that canola oil. And again, it just leads us right back to the situation where non-biofuel demand has grown so much that it's probably going to send ripples through not only through the vegetable oil markets, but probably also through the fat and grease markets, by extension through renewable diesel production and biodiesel production. So just where are we with Canadian crush? Fortunately, Canadian crush has been really robust. And in fact, if you look at the data from the weekly data from COPA, it implies that the March total is probably around 925,000 tons. That's back in track with the level that we saw during the record year of crush, which was 2 years ago. The question is, it still remains sort of, where will exports be over the rest of the year, and what will crush be? However, based on a change in my forecast for US canola oil imports, which I had to raise, and then I had to increase Canadian exports to kind of provide that supply, I needed to raise Canadian crush to provide sufficient supply to meet the increased demand from the US. we'll see whether that actually sort of plays out that way. And it wasn't a huge increase. It was like 200,000 tons. So it's not a huge increase, but we'll see if that happens. And if the Canadian ag industry continues to sort of favor crush over exports. I think they will, especially with their with the CFR sort of ramping up this summer into the September, into trading at the beginning of credit trading, which is in September. And so I think that while US demand is really strong, and I raised the crush, if that crush doesn't meet my forecast, then then we probably fall just a little bit short of canola oil in the US. Probably not enough that it's really that disruptive, and we go through the having to find non-biofuel soybean oil that we can use. But probably enough to make it so that canola oil prices return to a premium relative to soybean oil, at least in the short term, at least until we can get the US crop planted and we know what to expect from both the US and the Canadian crops. If we have problems planting either of those crops, then I assume that the crush probably won't meet expectations, but exports will probably slow down a little bit too, as it will sort of pay to wait to do something with the canola seed that is around. And I think that the next couple of months will provide some real insight into where we finish off the year and whether we do get to that number. Because if you kind of look at sort of the seasonality of Canadian crush, it tends to be, well, you can see it on here. It tends to peak in October and November, I guess, and then kind of run flattish through most of the rest of the year. But it's a little bit stronger in the last 4 months or 5 months of the year than if you look at US crush, which has a big peak in October and November, and then steadily declines throughout the rest of the year. So I think that, again, we're back to this question of what do we do with Canadian canola seed? Do we export it, or do they export it, or do they crush it? Given the strength of demand from the US, I'm assuming that they're going to crush it and then export the canola oil to the US, and we'll kind of track that and see if that actually materializes. One of the things that makes it tough is that, and we talked about this a while ago, is that Canadian canola oil yields are substantially below where they have been in the past. And so I think that that it looks like, just if you look at this chart, the trend and the pattern from last year, we're right on track with that, basically. Whereas the year before, we were basically in line with the 5-year average. Now, this is only really important, and the only reason I included this slide, well, there's 2 reasons. One, because it makes it just that much more difficult to generate supply from crush, and so you have to raise crush a little bit more than you would have to otherwise. But I think maybe more importantly is that USDA is using 43.5%, and we think that it's going to end up being 40.6%. And that 3% will make a big difference when USDA ultimately adjusts their forecast down to where yields have been. And I think that will then trigger sort of the cascade of effects through the US balance sheets that I've kind of talked about. So I think that even though I think we're above where USDA is on Canadian exports and maybe on US imports, I think that their balance sheet doesn't feature some huge increase in Canadian canola oil stocks that they can just draw down and then use that to increase their export or increase whatever forecast they need to increase as they draw down their production. So I think that there probably will come a change to USDA's forecast, and I think that that change not only will impact the Canadian canola oil balance sheet, but probably will have some implications for the US canola oil balance sheet as well. And then again, maybe the knock-on effect in an extreme case into the US soybean oil balance sheet, just because the yield is substantially higher than where we're expecting it to be, and honestly than where it has been for this entire year. So you can see canola oil exports are stronger than they have been, at least over the past several months, and we expect that to continue. Like I said, I raised them to 3.45 million tons this week, and that's 200,000 tons more than USDA's projection. So if USDA has bigger production in theory because they have a higher yield and higher exports, that means that their domestic use for Canada or some other number in the Canadian balance sheet has to be adjusted based on the fact that ultimately they're going to have to reconcile their yield with reality and probably increase their export forecast at the same time. So it may be that they just have a lot more going into domestic demand than really is needed. Although I would say that part of the reason that I increased crush is that I had a really hard time sort of adjusting other parts of the Canadian canola oil balance sheet to provide the additional exports to the US that just kind of fit with the seasonal pattern and with the strength of US domestic demand. So I don't know that they will have, if they have to reduce their production and raise their exports, I don't know that they'll have a lot of room or a lot more room than I have to kind of move stuff around and come out without implications for or changes to other assumptions outside of Canada. Maybe they can do that, and maybe there will be a difference in some of the non-biofuel uses that for canola oil. There may be some other things that you can substitute for canola oil, sunflower oil, or something like that, that will limit kind of the knock-on effect. But again, just based on where their yield is and where my yield is and how tight my sort of canola balance, Canadian canola oil balance sheet is, I think that ultimately it's going to mean that they're going to have to make some changes outside of that. Okay, on to palm oil. So palm oil really has ripped higher over the past week or so. It tagged the 3,500 ringgit level 2 weeks ago, I think on Monday, or maybe it was a little bit later than that. And from there, it's basically shot straight up to 4,000. Not quite, but almost. And part of the reason for that is Malaysian palm oil production. A couple of weeks ago, or the last time we talked about palm oil, I kind of showed the Southeastern Asian production and stocks and exports. And at that time, I think the situation was sort of rising expectations for Malaysian stocks and kind of a bearish story to tell about the fundamentals in Malaysia, but kind of a bullish story to tell about the fundamentals in Indonesia. And now you're getting to the point where they're both bullish. And then when you add to that the cut in crude oil production announced by OPEC on Sunday, the price of oil and the price of palm oil are pretty well correlated, or at the very least, the price of crude oil has a significant impact on palm oil, especially when it moves $5 higher in a day. And so that's helped contribute to it. But more than that is this sort of non-traditional seasonal pattern that we have in production. And so you can see here that production from an average daily output perspective typically bottoms in January and then rises from there pretty much kind of throughout the rest of the year. There's kind of that April to July period that can be kind of go one way or the other, but generally kind of, even if it goes down in 1 month, it's generally sort of range bound. And then you kind of start to rise in August and September towards the peak in October. And this year, based on survey data for the month of March, it looks like month over month production is down 9%. Now, February only has 28 days and March has 31 days. And so to do that is kind of tricky. If you look at the average daily output and you kind of adjust production in March to reflect a 9% reduction in average daily output, this is kind of where you end up with, in theory, production bottoming in March and then kind of rising. But that bottom in March has a really significant impact on production, because it also in theory impacts all of the months that follow it. So there is again a fairly strong seasonal pattern in production. And so if you start to knock March down, then you start to knock down April, May, June, July, August, September. And that's what we have done over the last couple of weeks. And the sum total of that from sort of our peak production outlook has been kind of a 1.6 million ton decrease in Malaysian palm oil production down to 17.75 million tons, I think, which is about where we were, I think, last year. Not, maybe it's a little bit above where we were last year. And that would be okay if exports remain really, really weak. However, if we look at Malaysian palm oil exports, while they aren't kind of as different from last year and the year before in the 5-year average as canola oil is in Canada, they are above where I think certainly where I expected them to be a couple of months ago. It looked like Malaysian palm oil exports weren't going to be that strong this year, in part because of what was happening in India with the incentives that they were using. We knew that was going to end and that there was going to be a change. But then the question was sort of what happens after that. And it looks like that there may be some lasting strength to the Malaysian palm oil exports going forward. And so if you just look at over the balance of the year, the increase relative to last year, it's about 8.4% that we're increasing it. So we took production down and we took exports up. And then that left a big hole that we had to fill because less supply and more demand. And it also then implied that that domestic usage would drop substantially. So I raised imports 400,000 tons. Imports are always a little, not necessarily tricky, but at least for me this year, I feel like this is probably the second or third time that I've kind of gotten whiplash from going back and forth on exports, where I started the year really high and then I cut them and then I raised them again at some point and then I cut them and now I'm raising them back again. A lot of Malaysia's imports come obviously from Indonesia, and so while I raised the import forecast by 400,000 tons, that assumes that Indonesia is going to be exporting at least as much as they did last year, which is potentially true, but there probably is more risk to that than than there was when I was at, now I'm at like 1.2 million tons. When I was at 850,000 tons or whatever, then it felt a lot more comfortable at that level, looking at the two balance sheets combined and trying to judge how much of the total Indonesia could supply. So if demand remains strong, and again, it looks that way, but I think until we probably get April or halfway through April, we need to see kind of a continuation of the strength of demand. If that starts to happen, then I'll feel much better about the export forecast and the other adjustments that I've made to the Malaysian palm oil balance sheet this week, because they were pretty substantial, honestly. And the final thing that I did was I had to cut ending stocks to get domestic usage up to where it has been historically, or in line with the trend historically. Part of domestic usage, and in fact, the larger part of domestic usage is biodiesel production. And with the move in crude oil, assuming that kind of continues to hold, then that part is probably a little bit stronger. For Malaysia and Indonesia, their biodiesel programs are come down to, from an economic perspective, a question of, is it cheaper for us to import oil, or is it cheaper for us and refine it, or is it cheaper for us to make renewable fuels? Just pure economics. And so sometimes it costs the government money to run their biofuel programs, and sometimes it makes the government money. When crude oil prices come down, it tends to cost the government money. And I think that was part of the reason, if you remember 4 or 5 years ago, when Malaysia and Indonesia were kind of starting their biofuel programs, there were kind of fits and starts to their biofuel programs, where they would announce that we're going to start here, and then it would kind of get delayed and delayed. And part of that was that just implementing their biofuel program was a net increase in cost for the country, and a relatively substantial increase. So the increase in crude oil prices, again, assuming it sticks, probably guarantees the larger part of the Malaysian domestic demand, and then the food demand is relatively steady, like it is in most countries. If it turns out that that Malaysian production is weaker or exports are stronger, and I need to make further adjustments to accommodate sort of the domestic demand, I probably will end up reducing the biofuel component of domestic demand, even if crude prices remain where they are or above that level, just because there really isn't any place else left to either generate supply or cut demand. I cut ending stocks down to 1.7 million tons this week. That's down 600,000 tons sort of in the last couple of weeks, which is a significant change. And so if supply falls further, if imports aren't what they're supposed to be, that's where I'm going to end up having to reduce demand. But again, then there also is the potential that maybe exports don't remain at this level kind of through the end of the year. Although typically you can see that kind of once you get to March, then export demand is kind of steady most years, kind of through the end of the year. Maybe it's in a range, but if you look at the average of the years where it moves around a little bit, that's kind of where we end up predicting. So part of the strength of that export demand is certainly from the U.S. And you can see that over the past really 2 years, U.S. imports of palm oil have been really volatile, but have kind of grown And in this year, if you look at kind of the marketing year, so start in October and then go to January. If you look at the marketing year, they have been well above the 5-year average and well above where they were last year. And this kind of fits in with this longer term idea where we're going to take however much soybean oil we take and turn it into biofuel, and then we're going to need to find substitutes for some of the non-biofuel usages of soybean oil. One of those is the feed industry. The feed industry has been importing palm oil to include in the feed rations. Now, the spread between soybean oil and palm oil has also made that a very economically wise decision to make. So the spread was 30 cents, and then it came down to sort of 20 cents, and then it was it held in that area for a little while. And then as palm oil prices bottomed and started to move up, then it's fallen. The one thing that I'll say about the spreads is there's a stark difference between the nearby spreads and the spreads starting in July. So July, August, September, if you look at the spread between those futures contracts, those all remain kind of around the 19-cent level, whereas the nearby spreads have fallen down to 13, 14 cents, somewhere in there. In palm oil, a lot of times what you'll see is that the very nearby contract, which typically, unlike the soybean oil market, where typically the nearby contract will be the most active, have the most open interest, the most daily volume. In palm oil, it's the third month out that is typically the most active contract. And the nearby contracts, while they're drawing down open interest, will do whatever they do in price. But then as the most active contract rolls from whatever month it is to the next month, and that month then gets closer and closer to the nearby contract, a lot of times what will happen is it will kind of mimic the behavior of the contracts that expired before it. So in this case, what that would mean is that as kind of the July contract moves on from being the June contract is the most active contract right now, but as the June contract rolls to the July contract, and then the most active rolls to the September contract, in theory, the spreads might mimic the decline that we've seen in the nearby contracts. However, at this moment, I think what the difference between the nearby spreads and the deferred spreads is telling you is that there's a couple of things that can indicate, right? So they can either indicate that relative to soybean oil, palm oil is either going to go down more in price than soybean oil, or soybean oil is going to go up more in price. Now, based on other evidence and things that we've talked about in terms of the short-term oversupply problem in the US in the veg oils and the feedstock markets, and the anticipated growth in biofuel or renewable diesel capacity and an associated feedstock demand increase, it looks like if you look at a chart of average daily soybean oil use, that starts to, it's been kind of below the last couple of years in the 5-year average, and it starts to go back up in April, at least based on our projections, and then crosses over all of that in May, and then kind of remains above everything through the balance of the year. And so the other thing that the strength in the summer spreads could indicate is that strength in perceived and anticipated soybean oil demand during the summer is supporting soybean oil prices in the back end of the forward curve. And if you look at say the look at the July SEP spread or the SEP D spread or any of the back end spreads for soybean oil, you'll see that they remain inverted. They kind of have been bouncing around a little bit. They ramped up and then they came back, and now they just kind of have been trading sideways for a little while. That also kind of supports this idea that that during the summer we could start to see a rally and maybe a significant rally in soybean oil prices. Again, not necessarily to test the old highs, but given what we've seen so far this year, where not this past week, but the prior week, we set the low for the year. Given where we are now, it seems there are a lot of reasons that it's easy to say that upside price risk for soybean oil is probably much more significant right now than downside risk. And I think the spreads are another sort of piece of that puzzle that kind of indicate that that might actually be true. Again, it may also be that palm oil prices will just fall more than soybean oil prices, or soybean oil prices stay steady and palm oil prices fall. But it seems to fit with a lot of the other data points that we see, except for a couple of really big ones that I'll talk about at the end of this. All right, so that's it for the slideshow today. Now, what I will kind of say before I answer questions is that the EIA also released its monthly biofuel production excluding ethanol data for January, and its renewable diesel and biodiesel capacity estimates for January. The renewable diesel capacity estimate, based on the EPA's data, based on the EMTS data from the EPA, implied a capacity utilization in January that was I think it was around 45%, maybe a little bit below 45%. The lowest it's been in several years at the very least, and certainly well below where we expected. And it is a direct argument against everything that I've said about biodiesel producers, renewable diesel producers needing to overproduce relative to the mandates to operate at a capacity utilization rate that is close to the historical average. Now, there have been some issues with some plants, and I think that probably contributed to this. But if you look at, and next week we'll look at a slide that will show capacity utilization and against production, that slide. And what you can see from that is that renewable diesel capacity utilization it was really volatile, but it was sort of in a range. And then over the last 6 or 7 months, it kind of has trended lower as capacity is expanded. And again, whether what I have thought is right or what I have thought is wrong, I still think that the capacity utilization question is probably the key question for the soybean oil market and then the feedstock markets more broadly. If capacity utilization for renewable diesel can run at 50% of what the EIA says continuously, then that has a huge impact on my expectations for feedstock demand and prices. If they can't, then I think that ultimately we're back to the choice of either you have to force some of the biodiesel capacity to shut down, or you have to build the RIN bank. Now, the RIN bank at the end of 2022 was lower than it has been. There's a slide that kind of shows that we've underproduced relative to kind of the mandate plus the undifferentiated advanced biofuel mandate plus the ethanol gap. If you add all of that stuff up and then look at biomass-based diesel production, it's kind of fallen short of those. And so it sort of makes sense that the RIN bank drew down a little bit. The big question is from what level and how much did it draw down? it looks like it. I would say that it probably got down to 1 million or less than 1 million RINs. And so there probably is enough room for them to overproduce. However, again, the January data suggests that that isn't happening, at least not now. And there is the caveat that that there have been some problems. And so maybe January would be a one-off. If we get sort of consistent February, March, kind of same capacity utilization rates, then again, I probably will go back and make some fairly substantial adjustments to my outlook and for soybean oil and the other feedstocks as well. But we'll kind of wait and see. All right, what time is it? Okay, let's just try and run through the forecast, the biofuel forecast stuff really quickly, and then I will answer the question here. So bear with me, sorry about this. Okay. So if we look at gross margins, this week gross margins kind of moved in the opposite direction as we sort of continue to unwind, or the market continues to unwind the renewable diesel premium or the biodiesel premium over renewable diesel. If you look forward going through the rest of the year, that really accounts for a lot of the difference between our outlook for renewable diesel margins, which are relatively flat, and biodiesel margins, which kind of go down. At first I thought that this was going to be a feedstock situation, and then I looked at sort of the difference in costs between our forecast cost between biodiesel and renewable diesel, and it actually turns out that we're projecting our feedstock mix for renewable diesel increases more on a percentage basis than our feedstock mix for biodiesel. And so if you look at the energy side of it, that really is what is sort of driving that disparity. For RIN prices, the RIN forecast was kind of straightforward this week. I didn't really make a lot of changes to it. There still is this kind of situation where if you look at, if I just forecast based on the HOBO spread, I think the D4 forecast would look a little bit different and be a little bit lower, particularly out in kind of March and forward going in 2024. What supports it there is if you look at sort of the equivalent of the HOBO spread for ethanol, if you kind of look at a spread between gasoline prices and the cost of corn, at that point, at least the futures market suggests that profitability out there will be tight. Now it's improved over the last couple of weeks, and so it may continue to improve, and I may end up cutting this more and more as we go forward. But that's really what's kind of driving the both sort of this peak in D4 and D6, and then kind of the narrow spread here in the first part of 2024 for the D4 and the D6. It's if I just did the HOBO spread, I probably would forecast D4 substantially lower. But the theoretical profitability of ethanol is kind of supporting that. In the interim, it's between here and there. It's really this expectation that that feedstock costs are going to rise pretty much throughout the rest of the year that kind of helps support D4 and kind of makes the D4 D6 spread widen out a little bit. For LCFS, I actually raised my forecast. I think last week I said, oh, well, maybe this will get flatter, and I don't think it'll get much lower, but maybe it will get flatter. And that's not what I ended up doing this week. I ended up sort of raising everything a little bit. If you look at the recent trend in LCFS credit prices, I think, you know, the bottom around 62 in the range somewhere around 65 plus or minus Prices have started to move back out of that range and started to move back up towards 70. We'll see if this is a sustainable move. I think that to the extent that that prices will increase, it probably will be really slowly. So if my life depended on this forecast, I might do it a little bit more slowly than is reflected here. But I think that that there's a good chance that we might have seen the lows in the LCFS credit price, and going forward that we kind of move slowly higher. Now that I've said that, you can almost bet your house that prices will set a new low next week. All right, with that, I've got one brave soul. What's driving such a significant yield improvement on the Canadian canola oil? So it's actually, this year is actually substantially lower than, it's about where it was last year, but substantially lower than it was 2 years ago, and below the 5-year average. And it really, the yield has to do with two things. One is significantly more important than the other, and that is the weather during the period where the plant is filling up the pods. And so if you get kind of hot and dry weather, if we just look at the weather at two extremes, so really hot and really dry, and then wet and cold, typically really hot and really dry tends to generate more oil than cold and wet. Cold and wet tends to lower the oil content in the seed. And if you think about last year, I think that that we finished off a little cold and a little dry in the plains and in the northern U.S. plains and the Canadian prairies. It seems odd to me that the year before, during the drought, that the yield is basically the same. But I can't remember. I should probably go back and look what the weather was at the end of that year. Again, if it was dry and maybe cold, then maybe that was enough to tip the yields down. But the weather while the plants are filling their pods really account for the vast majority of the year-to-year variability in yields. And before the last year or two, when prices have gone up so much, I would have said that the weather accounts for 100% of the variability in yields from year to year. And now we may be back in sort of that situation. But as prices rose, there are some things that crushers can do to increase oil yields a little bit. That's not a huge improvement, but it does make a difference. And if you just look at sort of the range of soybean oil yields, U.S. soybean oil yields over the past kind of 20 years, and you cleave off the last 2 years, or 2 or 3 years, and then you look at the yields the last 2 or 3 years, you can see that there's kind of been a little bit of a shift higher in the range that the yields tend to be in. And that part is just the crushers doing a couple of things that can help improve their oil production per bushel of crush. A lot of the time, well, historically, when oil's been at 20 cents, that's not so important. When oil's at 80 or 90 cents, then it tends to make a bigger difference. However, no matter what they do, it doesn't have nearly the impact that that the year-to-year variability in the weather during that pod filling will have on yields. Good question. Very good question. All right. With that, I will thank everybody again for attending. As always, really appreciate your support. And if you want to go, if you want to come to the the stable webinar tomorrow. I'm sure they would appreciate it. I would appreciate it. And I will, like I said, I'll talk a little bit more about what happened in soybean oil and what some of the implications of the planted acreage in the grain stocks data are on the soybean oil outlook going forward. Although I still think this idea of capacity utilization really is, I'm really, probably already tired of hearing about it, but I still think that is kind of the biggest driver of prices going forward. All right, I hope everybody has a great week, and thanks for attending, and I'll see you next week. Bye-bye.